$200.
Just kidding.
No, look. Remember, second thing. Right?
You got to be kidding me!
$200,000.
What are you gonna do with this money?
Well, no, I don't know. I used to not have anything, but now, well, yeah, maybe I think I'm gonna buy us a car.
Good idea.
$100,000 car.
Good idea.
Yeah, but what else should I buy?
You should get yourself a house.
Oh, yeah, I'm still right. How do I get a house? I don't have nothing.
Well, how much money do you have?
No, I want to buy a $100,000 car. I have another $100,000 to buy a house, maybe.
Well, you can go to Bank of America and have a
The best
loan.
thing you do, you find a house that you like, and then you kind of work backwards.
Okay.
So, you first figure out how much you want to afford, how much you think, you want to pay for a house to buy it, and then you work backwards to check the taxes and everything else and see if it fits. So what we do, we pre-qualify you.
Okay.
So we take all your income, your bank statements that shows your deposit, that you're able to afford to put a deposit. We take your income information, we process it, we do our calculations, we assume the risk, we check risk first, basically, to get you pre-approved. So then you get pre-approved, then you already know, hey, okay, that payment works for me. So then you go out and find a house for whatever that purchase
For a
price.
$300,000 house, you have to pay for a 20% down payment to avoid the private mortgage insurance, the so-called PMI, which left you $240,000 to borrow from the bank. You are given two choices by the bank, either a 30-year loan or a 15-year loan. For the 30-year loan, it will require 3.375% interest rate. However, the 15-year loan will require 2.5% of interest rate. Every month you will pay for $1,066 for 30-year loan and $1,600 for a 15-year loan. How do we get that? Bank of America. You will pay this much for a 30-year loan compared to this much for a 15-year loan. If you do the math, you will pay $141,960 more than the value of your house for a 30-year loan. And for a 15-year loan, you will pay $48,000 more. Dude, get a 30-year loan, you will pay $100,000.
Do you know what the interest rate like what it is today?
Well, that's a good question. One thing we should know is that interest is associated with risk. So the more risky, the higher the interest rate. And it all happens with like '08 when the secondary mortgage crisis hit. The bank used to not check the borrower's risk value, and then the house gets like crap and the bank crap house, everything, the economy goes bad. That's all because the risk. So the higher the risk, the higher the risk.
How do you evaluate risk? Well, you evaluate risk in a lot of different ways, and that's basically going to be credit report is going to be the major one. When they review your credit, you have certain credit scores. I'm not sure if you're familiar with that, but that's like a whole different. We can go into that and talk for months about credit scores, but we won't do that. But they look at your credit score. They look at history. They look at where you were renting from, how long you rented. If you're bouncing around from there. Bank of America says, okay, we know this is going to be a high risk, technically high risk loan, so you're going to pay mortgage insurance to assume that risk. Bank of America says.
Picture a teeter-totter. It's fun when they're going up and down. It's not fun when they're standing still. That's how our economy works. Real money and promises about money go back and forth in a constantly changing balance. It's called credit. Buying a house is a good example. Houses are expensive. So people promise a bank more money later to borrow a little money today. The promise they make, sort of an IOU, is called a mortgage. They get the house today. The bank actually owns the house. That's called collateral. Every month they pay a little bit back. The bank collects a lot more money than they loaned out in the long run. Having the money to lend is called depository banking because banks have to maintain big deposits of money to loan out. Another way money and promises go back and forth is called investing. Businesses are supposed to make more money than they spend, but sometimes they need money to get started or to run, so they'll promise some of the excess money from the future to get starting money today. The promise they make is called a security. Handling securities is a lot like handling money. So these banks are called investment banks. So, basically, there are two kinds of credit activities. You could say depository banks sell money for promises. You could say investment banks sell promises for money. Until about 10 years ago, the rules set by the government after the Great Depression kept depository activities and investment activities separate. Then, in 1999, the government eliminated some of these rules in what they called the Financial Services Modernization Act. Suddenly, modern financial services companies could do both. This connected depository activities with investment activities. For example, groups of mortgages were bundled together and sold to investors. These mortgage-backed securities looked safe. After all, don't people always pay for their houses? Shortly after this, the federal government also decided to help more people get houses. They sort of lowered the borrowing money side of the depository totter to help more people get on. Millions who couldn't have afforded to promise house payments before suddenly could. But it turned into what's called a boom. Lots of people wanted to buy faster than houses could be built, so the price went up. People temporarily forgot that up is always balanced by down. Many big financial services companies sold mortgage-backed securities, big bundles of promises. And since house prices were going up, investors worldwide thought they might return a lot of money. But the thing depended on most homeowners making their mortgage payments. Then the house buying teeter tipped back up. Some house payments became a lot more expensive, and some people who'd promised mortgage payments couldn't afford them. They basically had to jump off the end, and you know what happens when someone does that. House prices dropped and the boom disappeared. But the other end propped up the investment totter. The collateral houses weren't worth as much as the long-term mortgage payments. Without these, banks had to use their own deposits to pay investors. After a while, they just ran out. When a bank runs out of money to meet its promises, it has to close down. That's just what happened. Now the government is trying to decide what to do. Help homeowners? Banks? Investors? It's a worldwide problem. Meanwhile, the back and forth of money and promises that keeps the economy moving is slowing down. It affects currencies, businesses, hospitals, households, and everything. Credit is like air going in and out of a body. We can't keep running without it. We changed the rules to modernize our financial system, but we didn't get the job done.
The relationship between the interest rate and the risk. And a little bit the history background of what happened in 08. I know it's like a little tricky, but it is what it is. The interest rate and the risk are kind of associated. So if you want to get a low interest rate, you have to prove you have a very low
different things you can do with your interest rate. I mean, you could buy points or buy your rate down. Some people do. You'll hear them talk about points, no points, discount.
Right.
So there's a lot of different things that you can do in terms of where you want to be at.
Right.
When you say buy your rate down, basically you're paying to get a particular interest rate. You're paying additional points to get a 3.2 or 3%.
Okay.
But the problem you run into there is when you see that gap there, there's not a huge difference between a 3% to a 5% rate. You're talking $20 difference.
Okay, so do you, so when you like check the risk, does the risk reflect on the interest rate?
Yeah, good point. Yeah, risk does reflect on, because it's a risk-based lender is what we basically call it. And as you see, mostly everything is risk-based. You buy a car. What do you get? If you got a credit score of 750 and someone has a credit score of 400, they're not going to get the rate that the guy with 750 is getting. You're going to get whatever they do down here. So it's risk-based. So
You might want to switch to a 15-year plan. Interest rate directly associated with risks. If the bank can collect the money quickly, they're more willing to give a lower interest. Or you can give more down payment. From bank point of view, the more you pay as a down payment, the less you will own the bank. So that means the bank will have less risk. They will be happy to provide you a less risk
Then they
interest
also
rate.
look at your down payment. If you're putting down, how much money are you putting down? How much are you investing into this purchase? So the more you put into it, the lower the minimum your risk, because it lowers the bank's risk because the bank's not lending so much.
Is there how much you should pay for the down payment, like 30%?
Well, yeah, usually just for the minimum basics, it's 3.5% to 5% in that range, just to get you qualified in there. But the more you pay down, which you can, which eliminates certain what they call mortgage insurance payments and things like that. So if you go to 20% down, so Bank of America is lending 80%, then you eliminate what they call as mortgage insurance. So you eliminate that. And that's about $100 extra into your payment.
Okay, each month.
Yeah. So some people will do 20% to eliminate that.
Prepayment. If you invest in stock market, you never know what kind of return you will get. But if you have a 4% mortgage, then every dollar you prepay gives you a 4% return. In fact, prepayments are worth a little more than separate investment because income you make from separate investment is taxable, while interest you save by prepaying your mortgage is not.
I run into this situation like people doing a 30 years loan, but like they get great promotion and they can like afford more for the loan. Do they get like penalties if they want to like
Pay more on the account? No. There's not a prepayment penalty. If you want to pay more, you can. And that reduces your balance on your loan.
But like from our class, like our professor talks about sometimes you get penalty, like you want to like finish your loan earlier.
No, they don't.
They don't now?
It depends on what institution you go to, because you have to read the fine print. But in the normal general rule, you do not have a prepayment penalty anymore. There used to be that in place a while ago, years ago. There may be some institutions that still have it. It just depends on that particular institution. But Bank of America, we don't have that.
Okay.
So you can pay as much as
Great.
you want.
I can get so low interest rate and save a lot of money.
Hey, are you okay? Why are you sleeping here? Late for class.
Oh,